Can everyone hear me okay? It's good? So over the past several years, I've popularized the term "nothing stops this train." And of course, that originally comes from the show Breaking Bad. And for those that have not seen it, it's about a chemistry teacher who gets diagnosed with cancer and ends up going to the dark path of cooking drugs in order to pay for his own treatment and to support his family. But of course, the moral arc of the story is that he eventually cannot stop. Even when he's past his cancer, he can no longer stop doing what he's doing. And by the 5th season of the show, his colleagues are telling him, we really have to slow down, we're getting over our skis here. And he says, no, nothing stops this train. And I've been using that term to describe what's going on with US fiscal deficits. And I'll go into, during this pretty concise presentation, what that means, why it matters, and why it's so unstoppable. Because, of course, we're here at a Bitcoin conference, but there is this much larger dollar system that's happening around us and all over the place. And so the inter-exchange between what's going on in Bitcoin and what's going on in dollar land really matters for things like the exchange rate, things for the economy, investing in general. And so we'll start now. We'll go into these kind of pretty concise slides. Some of them will be simple slides. Some of them will be a little bit more complex, but I'll walk you through the parts that really matter. So this chart here shows 2 lines. One is the unemployment rate, and one is federal deficits as a percentage of GDP. And this goes back many decades. And as you can see from the slides, there's always been very good correlation between them. During recessions, unemployment goes up, the federal deficits go up, and during better times, unemployment is low and federal deficits are low. The one brief exception, if you can kind of squint and see it on the chart, is 1960s. That's when we had the Vietnam War. So there's a little bit of an exception. But other than that, these are almost the same line. But what you'll see on the right-hand side of the chart, and I circled it in green, is over the past several years, ever since around 2017, we've had a decoupling. We've had shrinking unemployment. We've had low unemployment levels. And yet the deficit has blown out to 6 or 7%. Even before and after the pandemic, this was already happening. Obviously, it went into overdrive during the pandemic. But we're kind of in this new world now. I'm not the first person to talk about the deficits, but I am trying to bring attention to what's going on now that was not going on for many decades. We're entering kind of a new era. So that's what the deficit is. But the second main question is, why does it matter? Why are we talking about it here at a Bitcoin conference? And the short reason is because it matters for asset prices, especially anything scarce. So this chart shows in the gold line is the price of gold, and the dark line, the black line, is real interest rates. And again, we've historically seen that there's been a very strong correlation between these two things. And so for those that don't know what I mean by real interest rates, this one is specifically the 10-year Treasury yield minus CPI inflation. And the reason these two charts, gold and real treasury rates, are so worth comparing is because they're the two primary reserve assets globally. They're the ones that compete with each other at that scale. And gold, of course, is pretty scarce. The supply grows by an estimated 1 to 2% per year, but you don't get paid any yield to own it. If anything, you incur an expense for storing it. Whereas treasury yields, dollars and treasuries, they grow at a much faster supply growth, but then you get paid this yield to own them. And during periods where the yield is rather high compared to measured levels of inflation, some of the investors that might otherwise buy gold get enticed to come back to the dollar and the treasury system. But then during periods of time where the yields are not high enough compared to inflation, many investors flock to gold. They basically say, if I'm not going to get paid anything on my treasuries, why would I own treasuries that are way more abundant than gold? And historically, this has been a very strong correlation. High real rates means higher gold prices. And on this chart, the real rate is inverted. So lower means higher real rates. And again, as you've seen over the past several years, this one in particular starting around 2022, we've had a complete decoupling in the price of gold and real rates. So something new is happening here in this kind of fiscally dominant environment. And of course, this is relevant for Bitcoin. A lot of people, if you would have said 5 years ago, if interest rates are 4 or 5%, would Bitcoin be selling out massive conferences in Las Vegas, and would it be worth over $100,000 per coin? Most people would say no. In fact, many critics kept saying that it's just a zero-rate phenomenon. It's some bubble that's going to go away as soon as the Fed gets any sort of hawkish in them. But what we've seen over the past several years is the Fed got about as hawkish as they could get. They even broke some banks in the process, and yet gold and Bitcoin both soared anyway because something changed. So these charts are a little bit noisier, but I'll direct you to the parts that matter, because this is the inflection point that really shows up. So the blue line on these charts is private sector year-over-year debt growth. So that's bank loans and that's corporate bonds, that type of thing. The red line is federal debt growth. So you have private markets and public markets. The pane on the left is 1955 to 1990, and the pane on the right is 1990 to the present. So this is a 70-year history. And if you look at the left side, for the most part, the blue line, private sector debt growth, was going up at a faster rate in any given year than public sector debt growth. And there are rather few exceptions that occur around recessions, and I mark those in yellow on the charts. And those are pretty few and far between. During recessions, the deficits would go up, bank lending would go down, and then we move past that. What you see in the chart on the right is that ever since the 2008 global financial crisis, and especially ever since in recent years, we've been in this period of time where federal debt growth is consistently going up at a faster rate than private sector debt growth. And I highlighted again in those little green boxes, if you can see them on the right, that even outside of recessions, this is still the case. So this was happening before the pandemic, and after the dust settled, after all the money printing, it's still happening now. And the reason this turning point really matters is because when we look at what the Fed, what their tool is to control credit growth, it's mainly interest rates. If they want to slow down the economy, slow down credit growth, and try to slow down inflation, they jack up interest rates to try to make borrowing less attractive. On the other hand, if they want to accelerate things, they tend to lower interest rates. The problem is that, many decades ago, when federal debt was low and most of the money creation was coming from private sector, whenever they raised interest rates, they would slow credit growth. They would slow the private sector faster than they would blow out fiscal deficits. The problem now is that now that they have over 100% of GDP, which only happened in recent years, when they raise interest rates, they ironically increase the federal deficit at a faster pace than they slow down private sector credit growth. Basically what that means is they don't have brakes anymore. The train, nothing stops this train because there's no brakes attached to it anymore. Or another way of putting it is the brakes are heavily impaired. We've kind of gone through the looking glass. We're in Wonderland now, where the rules that worked for the majority of this time frame now work backwards. They don't really have a way to slow down total credit growth in the system. And that's a new phenomenon. So for the remainder of this talk, I'll just go over a few slides of why this is so unstoppable. Why can't just a couple people get together and figure this out? Why is this so entrenched? Why is it that I'm confident to say that nothing stops this fiscal train, even regardless of election outcomes? I was saying it before the election, I was saying it after the election, because it doesn't really matter, nothing stops it. And so on this chart, we have, this is a pretty simple chart. The blue line is 10-year interest rates, 10-year Treasury interest rates. And the red line, we have debt to GDP, federal debt to GDP. And, back in the 1980s, you had very low debt levels and you had very high interest rates. And we've gone on this, 4 to 5 year decade journey of ever higher debt levels. But it's been offset by this structurally declining interest rate. And what that means, for example, if you double your debt but you cut your interest rates in half, your interest expense is still manageable. So for this whole 40-plus year period, interest expense was actually pretty manageable. But what happened is that eventually we hit zero. Just math kind of reasserted itself. And so now we're in an environment where the first time in decades, interest rates are not going structurally down anymore, and debt levels are still very, very high. They're the highest that they've ever been since the 1940s. And so interest expense is actually becoming a very meaningful part of the federal expense for the first time ever, and there's no easy way to get that under control. If they cut interest rates super low, then everybody wants to get into scarce assets. But if they keep interest rates high, they keep blowing out the federal deficit because we're kind of, like I said, we're kind of in Wonderland now. So that's a really big component. Another really big component is Social Security. So this chart shows the Social Security Trust Fund And as you can see, it went from 0 and it rose to about $3 trillion on that chart. And the reason for this kind of change that's happened over time is because of demographics. So the baby boomer generation was an unusually large generation born from the late 1940s into 1960s after the World War II, a very large generation. And when they entered the workforce, they were paying into Social Security. So we had this big ramp up in the amount of funds that were invested. Now, unfortunately, they didn't invest Social Security very well. They held it in U.S. Treasury bonds, basically, which are not the best long-term investment you can make. And according to the Social Security Administration's own numbers, by about 2035, they're going to deplete that trust. And what that means in practice is that they're going to spend down this $3 trillion into the economy. That's as the baby boomer generation enters their retirement years, which they're already doing and they're going to continue to do. This is going to continue to roll over. And if you notice, this kind of hit a peak in the late 2010s. So 2017, 2018, it was kind of hitting its peak and kind of starting the very early process of rolling over. And that's when deficits decoupled from unemployment. And that's when the federal debt growth started to exceed private sector credit growth. A lot of this timing happened because at around the same time, interest rates stopped going down, and the baby boomer generation that funded a lot of this on the upside is now in drawdown mode. So this is getting spent into the economy via healthcare, via travel, via housing, basically everything that people have to spend money on. And so this is a background expenditure that's going to go back into the system over the course of the next 10 years. Now, sometimes that exact depletion date will get pushed forward or pushed back by 1 year, but this is mostly actuarial math. It's kind of inevitable. And importantly, these people vote. Young people protest, but then they forget to vote. This demographic actually votes, and right now, anything that touches the expenditure of this fund is the third rail of politics. Both major parties in the US have vowed basically not to touch Social Security over this time frame. And so this is pretty much set in stone, even in a very politicalized environment. It's one of the few things the parties basically agree on. One of my last slides is to emphasize the Ponzi nature of the system. So even aside from current issues related to demographics and debt levels, basically the way the system is constructed, and by the system I mean central banking with fractional reserve banking built on top of it, the whole fiat system we've been kind of operating under for over a century, it relies on constant growth. It's like a shark that can't stop swimming, otherwise it drowns, ironically. It's a system that has to keep increasing. And so on this chart, the top line is total debt in the system, in the US system. So that's public debt and private debt combined, and it's actually over $100 trillion for the first time. And the bottom line is the monetary base. And what we see is that for the entire period of this chart, so this goes, I believe, from 1966 until 2025, the entire period of this chart, total debt never went down except for one very brief exception, and that was 2008. And it went down by about 1%, total debt in the system. And what they did was they rapidly increased the monetary base from $1 trillion to right now about $6 trillion. It was so impossible for them to let even a tiny amount of deleveraging occur that they kept the party going. And specifically back in that time, so if we do the math a little bit, in 2008, the total debt in the system was in the ballpark of $50 trillion. So it's about half as big as it is now. And they were on a monetary base of about $1 trillion. So the system is levered 50 to 1. That's the type of leverage you see in crypto degen derivatives contracts. It was it was 50 to 1 leverage across the economy. And specifically, they hit zero interest rates. So they couldn't keep propping up the private sector debt bubble. And instead, they rotated to the federal level. And so that kind of shows how sensitive the system is. As you've kind of gone forward, we're now more in the public sector debt growth. I actually looked at the data that goes back even longer than this chart, going back about 110 years. And there were only 4 other years where the total debt level ever went down nominally. And that was during the Great Depression. So 1930 through 1934 was the only other period beside 2008 on the chart where it went down. So 5 years out of over 110 years of data is their tolerance level for ever letting that Ponzi unravel. And that's just kind of the system, that's the math that we find ourselves operating in. And that's the big contrast that we have to Bitcoin. So for my last slide, we don't have to focus on the details here, but just by looking at the shape of these charts, these are century-long charts. And so my main point with these charts is we've actually seen this story before. We've gone through something like what we're going through now in the US one time in the past, and that was around the 1940s. So the reason that debt growth is so smooth historically is because when they do finally run into something that actually challenges it, they rotate the whole system around, and we're going through it for the second time. So basically, you have a private debt bubble build up, and then you hit 0 interest rates. So you can't keep adding more and more on to the accelerating private debt growth. And then what happens is you find yourself levered 50 to 1, and you start to unravel. And how do you unravel a system that's levered 50 to 1? The short answer is you don't. You just print more base units, is how they always handle it. So what that happens, they switch over to federal debt growth, and they switch over to running massive federal deficits, so that even as private sector debt levels eventually kind of mellow out for a period of time, it keeps growing on the public side. And that tends to be more inflationary, and that tends to be more persistent. Because as we get to the point that I mentioned before, when the Fed raises interest rates to try to slow any of this down, they blow out the federal deficit at a faster rate than they slow down bank growth. So basically, we're completely off the tracks now. And notice nothing I said is anything about Weimar, nothing's about hyperinflation. It's all about basically long-term, unceasing 7% deficit growth. We're not talking about 70% deficits of GDP, we're talking about 7%, but it's every single year like clockwork. It's the relentlessness of it that matters. And so as we go forward, this is the system that Bitcoin's going to exist in. And if we kind of summarize this whole talk, all these charts, all these points, there's 2 main reasons why nothing stops this train. One is math. The way that they've constructed the Ponzi system that I've talked about before, the way that it has to always continue growing to ever not start deleveraging in the crazy way that it would. So that's the system that they've built. And 2, the second reason is human nature. None of us want to pay higher taxes. People that are on the receiving side of deficits never want to cut them. Virtually no politician is ever incentivized enough to actually cut deficits during their term. And basically, this represents a flexible ledger. This is the ledger that we all kind of work with in the US and globally. And because it's a flexible ledger, they can always create more units. And therefore, that's the error correction that they keep falling back on over and over again. And that's what contrasts with Bitcoin. Bitcoin is, the complete opposite of this system in many ways. It's the mirror of this system. Instead of ever-increasing units, and indeed ever-increasing units that can't even slow down, Bitcoin is absolute scarcity. And instead of opaqueness, it's transparent. And instead of the error correction being able to just print more units, the error correction that happens in Bitcoin is deleveraging can happen, but you can never go after the unit itself. So basically, nothing stops this train. For the next 10 years, we're going to be running very large fiscal deficits in the US, almost regardless of what else happens. There are certain things that can accelerate it a lot. There are certain things that can maybe decelerate it a little bit, nothing meaningfully. And so the one way to protect yourself from that situation is to own the highest quality scarce assets. And of course, the one we all like here is Bitcoin. Thank you.